As we've been talking about all hour, the U.S. economy adding a lower than expected number of jobs last month, 150,000, suggesting an economic cool down. Let's dig deeper with Joshua Dobi. He's the president of North Main Financial Group. Thank you so much for your time, sir. We do appreciate it. So with this report, we still saw job gains. That continues to be the case month after month, but it is a slowdown from the previous month. So how should we interpret this latest report from the Labor Department?
Appreciate it, Jay. Thank you so much for having me on this afternoon. Definitely, we're starting to see some slower growth, and I think that's what's most important here. I think by most measures, certainly by most of our national economists, we anticipated that it was going to be slowing down faster than what it has to this point. However, especially here now over the last couple of months, and including today's jobs report, where we were anticipating upwards of 170,000 new jobs, looking at 150,000. This seems to be the intent of what the Federal Reserve has desired with the rapid raising of rates here over the last 18 months.
So we mentioned manufacturing losing 35,000 jobs because of the United Auto Workers strike. Is there a chance that with the next jobs report a month from now, there will be a snapback because that strike is essentially over?
It's a great point. And yes, I would anticipate that. That's a relative anomaly, meaning relative to the data that we saw here. So I anticipate we're probably going to see that come back. Also in that mix, we have to look at the Christmas retail season, which is probably going to skew the numbers again here over the next couple of months. That's an annual kind of occurrence, so it's not a new or unanticipated kind of thing, but we're probably going to get some numbers skewed to the positive because of the Christmas retail season as well.
So you mentioned the Federal Reserve. If you're Fed Chair Jerome Powell, you're looking at this report, it's a slowdown. You're considering the labor strikes that we've been seeing, and you're anticipating this holiday rush. How does that impact your decision on whether to raise interest rates or whether to leave them the same?
It's a great question, Jay. And I anticipate with the Federal Reserve's meeting here in December, so the second week of December is their next scheduled meeting, I anticipate there is at this point a possibility that they will not raise rates in December. As recently as a couple of weeks ago, I probably wouldn't have been that optimistic. But especially with this number coming now through the Department of Labor here this morning, it is possible that we may be at the peak as far as interest rates are concerned. We're going to have to see what data over the next couple of weeks will indicate, especially with regards to consumer spending coming into the Christmas retail season. But it is possible that we have reached peak rates.
And of course, one of the reasons we focus so much on these Fed interest rate hikes is the impact it's having on inflation. That's the Fed's goal, to bring inflation down, which impacts everything of what we pay for: gas, groceries, etc. I want to get your thoughts on what economist and New York Times opinion columnist Paul Krugman shared on social media. He said, "The war on inflation is over. We won at very little cost." This was before this recent Labor Department report. And we should note the CPI chart he shared does not include basics, including food, energy, and shelter. So it's kind of a selective view. He got a little bit of flack for making that assessment, for saying inflation is over. What are your thoughts, though, on this assessment?
Well, food and energy tend to be the most volatile indicators inside of inflation. So, meaning that they can be the ones that increase and decrease the fastest in any kind of measure. So, that I don't know that with Paul, but it probably was the reason why he excluded them from that kind of analysis. It may be the case, however, we are seeing some of the most significant sustained inflation figures, specifically with food right now. Fuel, not so much, because we've had a pullback in the price of oil, specifically with West Texas Intermediate now being in the low 80s. That has helped that inflationary figure. But on the food end of things, especially as it relates to the commodities that go into food, we haven't seen that pullback at this point. So while I would like very much to be where Paul is and saying that we have defeated inflation at this point, I think we still have a little ways to go. We need to get several months out from the Federal Reserve in their interest rate raising cycle before we really see the true effects.
Joshua Dobi, president of North Main Financial Group. Appreciate your insight, sir.